When a stock pays a dividend, it can have several effects on a put option trade. The key considerations revolve around how dividends affect the underlying stock price, the value of the option, and the overall strategy. Here's a breakdown of the effects. 1. Impact on stock price. Price drop on ex-dividend date. When a company pays a dividend, its stock typically drops by the dividend amount on the ex-dividend date. This price adjustment is due to the fact that the company is transferring part of its value to shareholders as a dividend. For example, if a stock is trading at $50 and pays a $1 dividend, the stock price may drop to $49 on the ex-dividend date. 2. Effect on the put option. Put options become more valuable since the stock price is expected to drop by the dividend amount. A put option, which benefits from a decline in the stock price, becomes more valuable. The decline in the stock price increases the likelihood that the put will expire in the money. For example, if you hold a put option with a strike price of $50 and the stock drops from $50 to $49 due to the dividend, the put is now closer to being profitable or is worth more if already in the money. 3. Impact on put option premiums. Higher premiums pre-dividend. If the market anticipates the dividend, put option premiums may increase leading up to the ex-dividend date because the expected price drop makes the put more likely to be profitable. Lower premiums. After ex-dividend. After the dividend has been paid and the stock price adjusts downward, the premiums may decrease as the dividend's impact is already reflected in the price. Effect on option Greeks. Delta. The delta of a put option may increase as the ex-dividend date approaches, reflecting the increased likelihood of the stock price dropping. Theta. Time decay, or theta, might accelerate for short-term options near the ex-dividend date as the market anticipates the price drop. Vega. Volatility, or vega, could rise if there is uncertainty around the stock's price movement, but typically dividends are known in advance, so this effect might be minimal. Strategy considerations. Early exercise of puts. Some traders may choose to exercise their put options early if the dividend is large and the stock is expected to drop significantly, locking in profits from the expected price decline. Hedging with puts. If you're long on the stock but expect a short-term decline due to the dividend, holding put options can help hedge against that price drop. Dividends in American versus European options. American options, which can be exercised before expiration. Since American-style options allow for early exercise, put holders may exercise their options before the ex-dividend date to capture the full benefit of the expected price drop. European options, which can only be exercised at expiration. With European-style options, there's no possibility of early exercise, so traders have to wait until expiration, and any price movement before that will affect the option's value. Summary of key effects. Put options become more valuable as the stock price drops due to the dividend. Option premiums increase pre-dividend due to the anticipated price drop. There may be strategic adjustments, such as early exercising or hedging. In general, if you hold a put option on a stock that is about to pay a dividend, the expected price drop benefits your trade. Conversely, if you are short a put option, you may face higher losses because of the stock's downward movement after the dividend is paid.